Hello, and welcome to Southeast Florida Real Estate and Lifestyle. I'm Susan Myers. This podcast focuses on the topic of lending. We are living in times where we have experienced unprecedented low interest rates for many months now. Here to talk about the lending market is Michael Eddy, Senior Loan Officer of Capital Partners Mortgage. Capital Partners is a mortgage company that is both a direct lender and one that can provide brokered options. Michael's going to talk a little bit about that. Prior to his career in lending, Michael was also a realtor and understands the dynamics associated with ensuring a successful real estate transaction. Michael has experienced the ups and downs of the market, serving in a variety of positions, including underwriting and processing, credit repair consulting, and originating. Michael's philosophy is that relationships come first. He adheres to that philosophy, creating for his customers a positive experience. Providing great service and a good experience means truly getting to know his customers. His motto is families, not files, as he views everyone he works with as a person with individual needs, interests, and ideas. Welcome, Michael. It's really nice to have you here.
Thank you. It's great being here. Thank you for having me on.
Yeah, we're going to have some fun. You know, we want to talk about Capital Partners. Mm-hmm. You think of it as a hybrid lender. I'd like to let viewers know a little more about that.
Absolutely.
And the difference between a direct lender and a mortgage broker.
Absolutely.
And where you fit in.
So there's if you look at the wide world of mortgage brokerages, there's usually two different types. Either you have a bank who's a direct lender, they give you the check and then they put the loan with them and their servicing and everything is done there.
Right.
That's one type of loan. Or you can have a brokerage where the mortgage broker is going to be selling that loan to a different company immediately. They never have it on their books, and usually sometimes they don't even have it held on their books for even the first payment. It just immediately goes to the next company. We are what's called a hybrid. And so what we'll do is we will hold on to the loans through our parent company. So our company is owned by another company who's owned by another company, as everything is in this day and age. And that company holds a bunch of different servicing corporations. And basically what we do is when we sell the loan, we sell it to our own family of companies.
There you go.
And so we have the ability to just go back and say, hey, there's an issue on this loan. If you have an issue in the future with whatever loan we take, we can just go back and say, hey, here's an issue. Let's go ahead and take care of this right here. Rarely ever do we sell it out to any other companies. But if we come across someone who needs to have it brokered out to, an Angel Oak or an Advantial or something like that, just because of certain circumstances, what we can do is we can also sell it to them, which is something that direct lenders can't really do. On top of that, just because of the way that our company is structured, we can also, because we have multiple different servicing companies, we actually price it out in different ways. And so we have the best pricing in the industry usually, and we have the most options in the industry usually, and we can get almost any loan done for as cheaply as anyone else or cheaper, which is very exciting.
Well, it is. Certainly for the consumer, it is. But I also, as I'm hearing you talk about this, what distinguishes this is that, there's control, there's quality control. Mm-hmm. Because once, as we've seen in previous years, mm-hmm. When it was sold to a secondary mortgage market and did go try to find it, mm-hmm. when we had the real estate trough mm-hmm. back in the early 2000s. So by containing this, you have, like you say, if anything comes up, you can always go back and you know where it is. You can track it.
Absolutely.
Yeah. So that to me really has a lot of value. In mm-hmm. addition to leveraging the fact that you're able to, because I think the power of that matrix that you described, mm-hmm. And let me know if I'm wrong here, mm-hmm. it allows you to have that kind of power to leverage the market.
Absolutely.
Yeah.
Absolutely.
Yeah. So the two combinations to me, giving me the right rate, but also knowing that consumers knowing that your loan is safe with us, and you can always come back to us. We know exactly what's going on.
Exactly.
Yeah.
Anything changes, we can even just, if you're going to be buying a new house or refinancing, we just copy the loan over, create a new one, and it's paid off in-house. Everything is taken care of.
Very, very transparent.
Easily, very
transparent, and yet very, very safe. Let's talk about turnaround times. When I hear this kind of stuff, and I hear a matrix environment, and I see self-containment and leveraging all of that, what would you say people, when they want to buy something, they want to buy something?
Absolutely.
Okay. What is your general turnaround time for getting pre-approvals?
So that is a great question, and that is one that has changed significantly in the last 6 months, or I guess the last 9 months. We've been in this whole COVID situation for a while now, haven't we?
Yes.
It's changed consistently. It's changed day by day. But really, what it comes down to is from the point that they put in the application, they have that first conversation with me, put in the application, to the point that I can get them that pre-approval. It can be within an hour.
Now, are we talking? And a question: pre-approval versus pre-qualification?
Yep. So a pre-qual is never going to be, you're not going to be pulling credit, you're not going to be looking at documents, you're not going to be doing anything like that. A pre-approval is going to be, we're pulling credit, and then sometimes we're glancing at documents, sometimes we're not, but we're always looking at credit, and we're asking those deeper questions and really making sure that we know what's going on in the file.
Right, and that can be done within that.
That can be done within about an hour, 2 hours.
Excellent. Excellent. Because pre-quals, that's been my experience. Typically, like within a day or so, you can get it. But a pre-approval with capital part, you can get that done within a day.
Yeah, absolutely.
Excellent.
And I mean, if I've had days where I've had 6 people apply in the same day, at which point sometimes it takes a little bit longer. But if I had someone this morning that they said, you know what, we really want to go with you. Here's our pre-approval, or here's our application. Put everything together. We really need to put in an offer by noon. And I said, sounds good. Let's go through this. Got everything done, and I got them that pre-approval, like I said, within about an hour.
Yeah.
And then the next question that goes along with that is going to be turn times for everything else.
That's right.
So the turn time from the point that you put in the application, you get that offer accepted. Say you get that offer accepted that same day, just for the sake of argument, we can close within about 30 days right now. It used to be shorter, but I'd say about 30 days, and 45 is really comfortable.
And that includes the appraisal and everything else?
Everything is within about 30 days.
Okay.
Again, 45 days is more comfortable, but 30 days
It can be done.
Can be done, absolutely.
Yeah.
I have several people that I work with, not that I work with, but that I connect with in the industry, just as friends, former colleagues, that kind of thing. And everyone else is dealing with, because they're dealing with brokerages or they're dealing with the larger banks that have a lot more overlays.
Right.
They're dealing with something at a minimum of 45 days, if not 60 to 75 days.
Yeah. Interesting, because when you bring that point up, I've also, being a broker associate in real estate, I sometimes I have to work with my clients. They prefer to work with their bank, and without a doubt, we're 45 to 60 days and keeping our fingers crossed. But that's how banks have traditionally operated, and I think because they are traditional environments and more parochial in how they are organized, that those times are extended. What that does, though, is it impacts the deal. Sometimes the deal is very much based on the buyer being able to secure whatever lending they want within that 30 to 45 day period, because sellers are not willing to wait or hang up their home for that long.
Exactly.
So I think that's where Capital Partners Mortgage can certainly come into play, for sure.
Absolutely.
Yeah.
Absolutely.
Yeah. Let's go into low interest rates. I mean, this is unprecedented.
Historic.
Yeah, historic, without a doubt. Let's talk about that a little bit.
Sure.
Low interest rates and we obviously know the Federal Reserve is involved in all of that, but I want to hear from you, your perception, your perspective of all of this, where we are, and also what you may see. We don't have a crystal ball, but if you had something, you could look out into the future and get your opinion. But we also know that, yes, low interest rates, but lending guidelines have also tightened up.
Mm-hmm. Absolutely.
So can we talk a little bit about that, those
Absolutely.
two things?
Yeah.
Go ahead.
If anyone out there does have that crystal ball, if you can let me know, that'd be fantastic. I would appreciate that.
I know.
You're absolutely right. We don't know what's going to happen in the next week. I mean, especially with what's going on,
Right.
we don't know what's going to happen, next week, let alone a year from now.
Yeah.
We do know that rates are very, very low right now, and the Federal Reserve has said that they're not going to raise their interest rates in the next year. They sometimes change their minds, sometimes things happen,
Right.
but we're expecting that it'll stay, those will stay where they are between now and then. Now, what affects us other than that, because we're not just going off of, we're not getting a loan directly for your loan from the Federal Reserve.
Yeah.
It's actually going through the stock market via the mortgage-backed securities, as well as the 10-year Treasury bond.
Right.
So I have my degree in finance as well as my MBA. So I love this kind of stuff. So if you want to do like a 3-hour segment on this, that'd be fun.
That'd be fun.
But kind of break it down a little bit easier for people that aren't quite as financially nerdy as I am.
Yeah.
To really break it down very easily is that essentially your interest rate is based on what the market is currently doing. Not just what the market is doing as far as the stock market goes, but specifically what certain indicators are doing, and then also what the 10-year Treasury bond, which is a bond and not a stock, is doing. And so there's a lot of different factors that happen that affect it. So the Federal Reserve may not have changed their rate for the last 6 months. I can't remember the last time they changed it.
Right.
But those rates have changed every single day. So we're expecting, if the Federal Reserve doesn't change anything, for rates to stay fairly steady. But we're also expecting that if the stock market goes up, interest rates will go up too. So it's kind of one of those things, you never lose money by locking in savings. That's an old mentor of mine used to tell me that consistently. So I say if you feel like buying something now and if you feel like that's the right time, to do it, because rates are very, very good, and that will not preclude you from refinancing later on down the road.
That's right.
So there was a second part of your question that I completely forgot at this point.
Oh no, that's okay.
We went off on
We're
a tangent.
talking. No, this is good. I like the tangents because I think what happens is it helps to take people off the dime, so to speak.
Mm-hmm.
Don't procrastinate. Don't be afraid.
Absolutely.
Right. Lending guidelines. So talking about that.
Yes. So the interest rates are historically low. And when I say historic, I literally mean if you look at the last 100 years of mortgage rates, they have never been lower for a par rate. Now, how do you get that par rate? That rate is going to be based on an 800 credit score. That rate is going to be based on a $350,000 loan, because that's considered the average. That's going to be based on a 30-year fixed rate. That's going to be based on a bunch of other things. Mm-hmm. If you take a look at all of those things and you take a look at how many borrowers actually fit into all those boxes, there's like 4 of them. So no one is going to fit into that box. Yeah. So your rate is going to be different. If it's up or down or sideways, it'll be slightly different for different reasons.
It's all relative.
It is all relative.
Mm-hmm.
And so when guidelines tighten, it's not that you can or can't get a loan because of the rate is here. It's that the rate will shift based on how well qualified you are. Mm-hmm. So if you are very well qualified, you're going to get as close to that par rate as possible. Got it. If you're not very well qualified, if you have a 640 credit score, then you're going to be kind of towards the
it's a weighting.
Exactly.
Kind of a weighting system.
Exactly. It's a good way of putting it.
Okay.
So if those guidelines have tightened, that means that we can still usually do the loan, or we can do it in the next few months, but your rate's going to be higher.
Right.
So the par rate, the good rates out there that you might say are, the 2.5-3% range, you might be getting a 4 or 5% because you have bad credit. Right. But that doesn't mean we can't refinance down the road.
Correct.
So the guidelines tightening up mean that there are necessarily fewer loans out there for people. But at the same time, that also means that it might just be that you have a higher interest rate. So what I always say is, it never hurts to look.
Exactly. It never hurts to apply. It never hurts to go out there and see where you stand.
Exactly.
Without a doubt. And it seems to me, correct me if I'm wrong, if you went to an institution, a lender banking, that it might be a little more challenging as opposed to, say, going through a mortgage broker. It seems there's more elasticity to play with those folks whose credit score isn't 800.
Exactly.
So that's something just to keep. I mean, that's been my experience. It's an institution as opposed to a brokerage. It makes a difference. It also makes me think about jumbos. If you had, because I deal with luxury buyers and sellers, and part of that is some of my buyers are coming in and they're saying, you know what, Susan, I would pay cash for this, but I can get an interest rate that's so darn under 2 sometimes. Now, with that said, I wondered, so they'd rather finance some of it. So what is your maximum? How high is your ceiling for jumbos?
Ours is $3 million.
$3 million. Okay.
So
I did not know that. Thank you. Yeah, no, I was not aware. Yeah, good.
And we've got pretty darn good pricing for that. And if you go to some of the larger companies out there, some of the larger banks, they have very, very, very strict rules. And so if you're one step outside of that, they can't do it at that point. So that's where we have, like you said, that elasticity that other companies don't have.
Right. It's not how they are built. It's not their business model. And I understand it. I appreciate it. Absolutely. Let's talk about, some of the things I find people doing. They sometimes do the wrong things when they're out applying for a mortgage loan. They're buying the furniture for the home before they move into it. And they're picturing that brand new car sitting in the driveway and things like that. It's the human stuff. So let's talk about what to do and certainly what not to do when you know that you're going to go out and you're going to start applying for a loan.
Absolutely. So the first thing to do is to continue doing what you have done for the last 6 months. As long as that is, paying your credit cards and your loans and everything else on time consistently, not going out and opening any new credit. Don't go and buy furniture. Don't go and buy a new car. There have been a couple of times where I've had a day or two from the closing table and someone said, hey, I'm really excited. I'm going to go out and I'm about to buy this new couch. I'm like, oh, no. Stop. And so we were able to complete that loan and then move on. But there's other times where they don't tell me that, and then we find out the day of closing, and we have to either delay the closing to later on that day because we have to run it back through underwriting, or worst case scenario is they can't even get the loan because their debt to income ratio doesn't work. So really the main thing is to just don't open any new credit until we close. And there is a consistent check on their credit. Anyone who checks their credit, we get notified. So if you go out and you start looking at furniture, it's not even if you buy new furniture, we will get notified if you are looking and you had your credit pulled.
Correct.
So don't give anyone your social security number until.
Well, that's fascinating. So you're telling me that someone's in the loan process with you, and I know that you monitor this without a doubt. And the day before closing, you pull. I get it. I certainly understand that.
It's a soft pull. It's not a hard pull.
But nonetheless, okay. So with that said, you're telling me that if someone goes out and decides to run their card, they're buying whatever, okay, that you're actually being notified.
Not if they just run their card and they've already got their card open. If if they are opening new credit, or if they're having their credit checked.
Okay.
So that's where it's if they're. Sorry, I wasn't clear on that.
No, that's okay.
If you're looking to buy a new car,
right?
But you haven't pulled the trigger yet, we still get notified saying, hey, this
Very
person's
interesting.
credit was checked.
I was not aware of that. I understood that you would pull credit day before closing, or certain within
a couple of days before.
But I wasn't aware that you, as the lender, which makes sense, would be notified that this person you're working with has indeed went out and bought a new car.
Absolutely. And if
Interesting.
if they have checked their credit, if the last time you looked for a car, the lenders that are for the cars will go through it and they'll pull your credit like 16 times for all the different companies that they can sell it to. And so your credit score goes from 750 to 650.
Right.
And now we can't do the loan.
Right.
Because of something.
Of all that.
And so, or your interest rate goes up through the roof because your
Right.
credit score went
You
down.
really can't be dealing with other companies and how they do business. Like you said, they'll just keep pulling it. No, that's a very, very good point. I wasn't even aware of that piece. No, thank you for that. And I hope everybody is listening here, because it is not unusual for things to happen. And it's an innocent move on everybody's part, but it certainly can end not so well.
Yeah. I mean, when I purchased my last house, my wife and I were about to go out and like, hey, we do need a new car, and that would be helpful. And like, nope. I'm a mortgage broker. I should know better.
Right. Very, very smart. Very smart.
So yeah, I recommend don't do that.
Don't do that. You know, as I'm listening to you, I'm thinking of all kinds of reasons to have you back, because there's like to talk about what we were talking about earlier on, you know, the market in general and Federal Reserve and the bonds in 10 years. Absolutely. And we will. I hope you'll come back.
Fantastic.
But I want to talk about other ways that Capital Partners Mortgage distinguishes itself. We talked about some of that, okay? But before we distinguishes itself from other lenders, okay? But before we wrap it up, I wanted to just make sure that we didn't miss anything. Was there anything else we can add to that?
So the one big thing that I feel like, you know, I used to sell, you know, myself as a loan originator and Capital Partners a lot of different ways. And really what it all boils down to, what I think is kind of the crux of what we do as a company and what I personally do. I am honest, I'm transparent, and I'm going to be keeping you as a borrower in the loop, and also you realtors, that everyone knows what's going on.
Yeah.
And on top of that, my boss is the president of the company, and he and I chat every single day. So if there's something that's going on, we're able to speak, figure it out, maybe get with the head underwriter and figure it out, and then move on. If you talk to someone at Chase, Jamie Dimon is like 15 stages higher than they are.
Right,
so
right.
there's a lot of you know, slack there. So if you come and work with me, we're going to be able to figure it out, and I'm going to be just completely transparent and honest.
Right.
And you're going to know what's going on.
Yeah, and that says a lot, because it's like, you know, any other, when you get into a private company that's not publicly held, there's all kinds of advantages to that, because they are, unlike some of our banks and things that are indeed publicly held with stakeholders, it makes such a difference. You know, private situations you can turn on a dime. That's the beautiful part. You can. The Queen Mary has not left the dock here. You can really turn on a dime and get problems solved pretty quickly.
Very.
Yeah. So no, that's a very good point to bring that out. So I think we've covered a lot. I mean, I feel good about what we talked about today, but I'm really curious about some of those other things that we could talk about, as I said earlier. The Federal Reserve, the bonds, and how that all plays out. I think if we could even do a session on that might be helpful for everybody to understand that, because that's really at the crux of it all, is it not?
Yeah, I mean, that's what it all kind of boils down to, is how all of that works. And then also on the other side is how the borrower themselves look.
Correct.
I'm just kind of the in-between that that holds everything together.
Indeed.
So.
But I think the value that I hope this podcast brings to people is that there is a process, and that it's manageable. And if you understand the process, then you know where you are within that process, and you'll behave accordingly.
Absolutely.
You know, and you'll be able to judge accordingly when it's time to move, when it's time for you to buy, buy or sell. Well, thank you so much. I think we're getting a heads up here. I think we kind of used up our time today. But for everybody, if anyone has questions, I'm going to share a little information
Absolutely.
on Michael. For those of you who have questions and would like to reach out to Michael, his email address is michaeleddy, EDDY, at capitalpartnersmtg.com. Okay, Michael.Eddy.
Michael.Eddy.
Michael.Eddy at capitalpartnersmtg.com. You can also reach him at his office at 561-614-4753. And should any of you have interest in buying or selling in Southeast Florida, you can reach me directly at 561-676-5786. My email address is Susan Myers, Meyers, at Keyes, KEYES.com. Thanks so much, everyone. Have a great day.